to Community CPA's webinar. You know we have this almost every 3 p.m. in the afternoon. Saturday 3 p.m. is my time with you, and we choose a topic that coming to light during the week. And we really don't have a long range like a 12 months plan, no. But we have a week. So during the week, and we hear what our clients are telling us, then we bring that specific topic to you. For example, last 2 weeks, we have a lot of R&D requests from our client. You know why? You know why suddenly R&D is here? It's because the 2020 R&D amendment is due next week, Friday. Yes, it is due. So if you still have R&D work to do and you want to claim your tax credit, you better hurry up because you don't have many time to work on 2020 anymore. 2020 amendment due this Friday. So with that saying, with that said, and that's why we talk about R&D a couple of times for the last 2-3 weeks. But today I bring to you a topic called all about C Corporation. And you know what I am talking about, C Corp. You heard it. There's a lot of comments about C Corp. Maybe you already have one, or maybe you don't have one. Either way, and we want to give you the potpourri of everything related to C Corp. Of course, when I say everything, I am not an attorney, so not able to give you the most in-depth analysis on the legal side, but C Corp related to your bottom line, related to your money, that is what we're talking about today. So let's get going right away. I will start sharing with you the PowerPoint I prepared for you. All right, you see what I see, and this is all about C Corp. Always, before we start this presentation, we talk to you about our firm. Not because we're here to brag. There's no need for us to brag because we're just so amazing and people love our team. And the reason we want to mention that to you because I want you to see our journey. And this firm has already been on the market for more than 26 years. Started with one person, one account. Today, we have more than 30 professionals and we have more than 10 different languages spoken collectively by our staff. We have more than 12,000 clients worldwide. So that gives you an idea of what 26 plus years did to us. And we have 4 branches currently. We're opening up our number 5 in Houston, Texas in June of 2024. So look us up online. You will start seeing the pictures of the building. You'll start seeing our progress. It is kind of exciting for us, right? We don't really establish branches every year, but maybe every 5 years I felt like that's how we did it. And this is exciting time for us to get that kick going. And I myself as a CEO and a managing partner for Community CPA, I do want to brag about 2 things about myself. Number 1, I have served on National Taxpayer Advocacy Panel, which is the Federal Advisory Committee to provide advices to IRS. And I also I am the author for 2 books. I am writing my 3rd one, and I promise to bring you the 4-book series about business. So 8 a.m. starting up a business, and 10 a.m. growing your business, 2 p.m. expanding your business, and 6 p.m. retiring from your business. And we're working on the 2 p.m. and we will be putting that on Amazon just like this too. And you can go on Amazon to buy our book. And by the way, every penny of the book we sold, whether it's online or is on our event, is donated to a nonprofit organization called Immigrant Entrepreneur Summit. And we have been donating every money we receive on this book to IES, and wanting to support this nonprofit to build a platform, an immigrant-owned business, or someone who has never grown up in the business family and tackling about business issues and learning it just like a new immigrant to the business land. If you are one of those, the book we have here helps you, and also IES event that happens throughout the year can help you. To know more about IES, you go to www.iesusa.org. That's a 501c3 nonprofit. All right, of course, when we do free webinars like what we do right now, the content, it is important. You learn and you apply to your business. But just keep in mind that here we're putting a no responsible disclaimer for the protection of the firm, because this webinar is free. So very often, if you used it wrong for whatever reason, or even because we didn't know thoroughly of a topic and we spoke it wrong, all of that is included in this disclaimer, because we want you to know that it's a free service. We really are sincerely here to help you, but that doesn't mean every golden word we say is truly golden, right? So you want to make sure that you take responsibility of these advices you get free from the internet and really vet it through. If you want to make sure that we're absolutely right, we're saying the right thing, you want to just go ahead, subscribe to our service, right? That way you will for sure be implementing something a professional recommended to you. Of course, I emphasize on that because when you do have that service relationship going, you are ultimately covered by those what we call malpractice insurance, right? Community CPA also have such an insurance to make sure that if we really cause so much damage to a client, and if ourselves couldn't afford to pay for that, then the insurance company will step in to help us to help with our client. So our interest is in you. Our interest is to make sure to protect you. That's why we're getting insurance to cover you, right? So service relationship is therefore very important. Okay, now how is C-Corp special? Why not S-Corp? Why not LLC? Why is C-Corp is so special? And a couple of things to bring to your attention, and I will go through the slides and really kind of knock off a lot of things that related to C-Corp that you heard the buzzword, but you don't know exactly what that means, right? So C-Corp is a separate legal and a tax entity status. When I say separate legal, this is where the court cases and the things, placing judgment on C-Corp, or even if you file bankruptcy on C-Corp, it is separate legal entity, separate tax entity. So it is profit, it is the loss, its profit is loss, and everything belongs to that structure. It's completely separated from what? From your personal entity, which is the 1040, and from your other entities, which might be S-Corp, might be LLC, who knows? You might have other things, right? That is why their bankruptcy filed only bankrupt just that entity. And President Trump did several of them, and they are C-Corp. So it didn't affect his penthouse and didn't affect his lifestyle, because it is just location-wise, it's just on one entity. So bankruptcy is filed based on entity, right? So it's one entity filed bankruptcy, doesn't mean the other one didn't do well, right? So that is an advantage of C-Corp. Then unlimited number of shareholders, and it is also a big benefit. So for S corporation, you are limited to 100 shareholders, right? So there is a limit for S corp, but for C corp, no limit. You can issue additional shares to your coming up shareholders, and you can make a large scale business, just like Microsoft, Google's, and all of these public traded companies, and they have these shares to issue to you when you buy. And so that shares is not something, they have to count how many people buying it. Did we go over the limit? It's like unlimited. So they can do that. And one other benefit is that C corporation shares can have class. What does that mean is, those are the conversation most likely the attorney will give you, but the tax people also really care about that. Let me tell you why. When you have a different class of the shares, the treatment to the shareholder is different. So for example, if you have a common shares, which you have a voting right, then those shareholders are the one making the rules in the company. But if your preferred share, your class B, then you know that you just get a dividend, but you don't get a say for what's going on with the company. So if you are a preferred shareholders, and then when you sell your share, and then that is one treatment. But when you are common shareholders and you liquidate your company, then you have a different tax treatment. So with the share differences there, you have that. And there's more, obviously there is more details to what kind of shares is to issue, how you issue that, what is the cost of the shares. They don't have to cost the same. You can label the price in every stage of the development for your share. Just like when you go to Tesla buying shares 2 months ago is different than right now. So it's like the shares is driven, the base is driven by the market or by the shareholders of the company, and they call the shout. Okay. With that said, and the other thing for C-Corp is also special is it has more complex regulatory administrative requirement. And this is said a lot of times by the attorney's office, and then we get our client coming in and goes, what does that mean? And so I'm just going to give you an example. For example, you must, if you are a C corporation, you should have a regular shareholder meeting and maintain that meeting minute. And you also have to approve the resolution that the company wants to approve. For example, the CEO's salary, accounting firms like KPMG, and they have to approve their CEO salary at the shareholder meeting. So those are the things that resolutions would drive. But the meeting minute is the one that internal document, but you must do it. Some of the C corporation just coming into their lawyers on the annual basis to get that meeting minutes done, to give them the content on the regular shareholder meetings. This is where you remember there's people will say that, oh, can I deduct my travel expenses because the only shareholder in the C corporation is me and my spouse. And we went to Hawaii to have annual shareholder meetings. And by the book, because you are the shareholder and you are the board of director and you need to hold a regular shareholder meeting, so the answer is absolutely you have expense to deduct, right? But whether that particular trip really is 100% for business, that is you needing to report back to your tax preparers. When you do the tax preparation, you will say that this is piece of the cost that is 100% related to the regular annual meeting, but there's also part of the places we paid on our personal expense because they are not related to the shareholder meeting. So with that, you give that right, I think you give that right vibe in terms of how exactly you account expense. It is very dangerous for you to simply just, everything is a business deduction. Of course, you can say that nobody going to questioning you. Your tax preparer is not in the business to audit you, so they really don't have the business to say that, are you sure you're saying the truth? And that's just so disrespectful, right? To anybody. If you walk into our office and we go, you're just absolutely lying. We can't say that. And we believe you're not lying. So with that kind of understanding, you want to make those kind of things clear for the tax preparer. You're supporting their work, then they can help you to think, right? So we also have tax folks that our company owners, have so much expenses, and a lot of it is even related to their employees, and they paid their employee for certain places. Of course, it is more have to send them off to take a break and relax, but it is really for business reason. Then they are not even sure whether they can deduct that or not. If they talk to us, we will do the analysis and according to the rules advise them properly on that deduction. And the other thing about C corporation is special is this rate. C corporation has 21% of rate, flat rate. And even if you make $1, you still have to pay 21 cents. So I want you to compare that with the personal income tax rate that we see on our 1040. We only have these two rate system, right? One is for the corporation, one is for the personal. And just look at this. This is a personal, and the personal tax rate. And that you see the red ones is I actually highlighted for you. And those rate is already more than 21%. Did you see that? It is 22, 24, 32, 35, 37. And I didn't even mention about that 3% of the investment tax that would come in. So make you 40%. So what I'm trying to draw your attention is that same amount of money, if it is sitting in the C-Corp, it will pay less taxes than that money sitting in 1040. So that's the fact. So I want you to know this fact, and then, then understand a lot of things that we implement or we explain to our taxpayers. And so I know you're going to ask me, Ying, that's not true. And there is a double taxation. So, okay, let's talk about double taxation. So what is double taxation? This is referred to the taxation of corporation profit at corporation level for the first time, then at the shareholder level for the second time. It is a double layer of taxation. So they call that double taxation. And this double taxation contrasted with pass-through entities like S-Corp and LLC, right? Because let's say we got $10,000 profit in C-Corp, and we tax that for 21%. So the C-Corp left over with $7,900 profit after income tax. So 7,900 dividend distribution. If I just distribute that to the shareholders, and the shareholder pay that 7,900 taxes on their 1040 for dividend tax, right? So this is what we call a double layer taxation. But if you have an S corporation, you have a $10,000 profit, what happened to that? And you take the 10,000, there's a K1, and then you just tax it twice, tax it once, right? Just tax it one time in 1040, and your 1120S tax return is totally a formality. It's calculating the K1 so you can pay it on your 1040, right? So I know that is directly contrasting that, saying that, look, in that case, they only pay it once, so they don't double pay taxation. So you're gonna ask, is it better to be S-Corp or LLC to avoid double taxation? And then this one, it is a $1 million question. You know why? Because it is not apple to apple comparison. And I would wish that S-Corp, LLC, exactly the same as a C-Corp. Then we can just simply compare the rate, right? It is not so. So if you really want to know whether double taxation works worse for you, or maybe you don't care, and that is to require your tax preparer to do simulations for you. Hey, can you simulate this profit for me in C-Corp versus in the pass-through entity? See how I come out with my taxes. You'd be surprised. Even though you are doing double taxation on C-Corp, you still come out less taxed than moving the money into 1040. Just depends on which tax level you are at. Make sense? You know, if I go back to our chart, you look at that. If you are making $609,000 or more on your income, and you're 37%, okay, 37 minus 21, we're talking about 16%. The maximum dividend tax is 20%, just depends on what level of income you are at. So there is a calculation that your CPA firm can do, and you can engage our firm to do that analysis for you at the time we do tax planning. And I'll tell you that we do that quite a bit to see at what point of time a corporation, a S corporation, should really become a C-Corp. All right, so say you have a C-Corp. Then you are saying that I'm making too much money, I can't take money out. So let's talk about you make too much money in C-Corp, you can't take it out. And you want to take money out. If the corporation has money available, you as a shareholder draw cash out of the business. The easiest way to characterize this draw is to make it a dividend payout. Yeah, easiest. Because I say easiest because a lot of tax preparers or people who are not in the tax planning arena, they're just a computer preparer. They're not a tax scholar. They don't study it. They will make it a dividend payout. However, a dividend distribution isn't tax efficient since it is not deductible by corporation, and it's also taxable on your personal return, right? We knew that, and we use that 10,000 as example. If I do dividend distribution, I'm distribute 7,900, and so my corporation paid 21%, and I take 7,900 from 1099 dividend and report it on my 1040. Then if this is my only income, I would end up not paying any taxes. But if this is not my only income, I may end up paying 20% of that amount. So it really depends on your rest of your tax world. But we want to mention to you is that is not a tax efficient way to issue that as a dividend. So let me summarize there for you. We have 5 approaches for C-Corp shareholders. You can pay yourself a salary. You can pay benefits, you can pay capital repayments, you can do loans, you can do property sales. So let's just quickly go through each one of them on salary. And a reasonable compensation that you receive from the service, that rendered to corporation as expense. So, when I say reasonable compensation, you might think that, well, I heard that term from S corporation. I thought you said that C corporation doesn't have that issue. So let me tell you, the word of reasonable doesn't mean that you're paying yourself too low. The word of reasonable could also mean that you're paying yourself too high. So reasonable compensation in S corporation world mostly subject to you're paying yourself too low. Because S corporation K1 do not subject to self-employment tax. So there are S corporation owners paying themselves so little. We had a case, right? If you notice that there is a one reasonable pay S corporation tax court case that brought by a CPA firm in Iowa. And what happened is the shareholders were paying themselves a salary of $20,000 a year. And these are partners. They pay themselves $20,000. Do you think that's reasonable? No, it's not. As a partner in a CPA firm, and it's okay you don't make $100,000 because your firm is not that profitable, but to say you make $20,000, way unreasonable. And so there is a court case related to that, but they distribute $250,000 on the K1. So the $250,000 doesn't pay self-employment tax, and the salary pays Social Security, Medicare. So the way they're doing it is ultimately going away from paying self-employment tax, right? So they're saving about 15% on every penny they're making. if you add their salary to their distribution, they're saving 15%. So that's why it went into tax court, debated. So I think, I didn't remember the final salary determination. I think it was around 60,000. So that was the reasonable pay, and then the distribution will reduce by about 40,000 because the 60,000 went into W-2, right? So that is the world of S-Corp. The world of C-Corp, a lot of time, the reasonable compensation is paying too much, all right? So with that said, and you just want to be reasonable, when you are a owner or the only shareholder for the corporation, if you work, you need to pay yourself a reasonable compensation. And if you don't know what is reasonable, we are here to answer that question for you. Or you can go to DOL to look for prevailing wages. Type into your zip code and give your title of the position and see what is the range in your area the salary should be. If you work part-time, then you divide it by 2, and it will be a pretty straightforward determination. There is no guessing game, and it is what it is, all right? So salary is one way. Why is salary such a big deal? I will tell you that the salary is also a determination of a lot of benefit. If you don't have a salary, you buy key employee insurance to cover if in case you die and the company not going to fold next day, and you can't even do that, right? You're not an employee. How could you buy key employee insurance? And then what about company offered medical insurance, dental, vision, and what about life insurance? What about 401k plan and qualified for pension plan or non-qualified plan? So all of these plans are made for people who work in the company. So if you don't start with a salary, you sort of just shoot yourself on the foot and it eliminated all the benefit that you could get. So I want to say that to run a successful business, ladies and gentlemen, you want to make sure you pay yourself a reasonable salary. And I want to plug one thing right here. A lot of times when people run salaries, they think their salary is simple, so they go for 1-800 number payroll provider. It is a mistake. The reason I say that, because when you are such closely held company, you can actually change your salary, make it different, and do additional things before December 31st. So your salary, 941, 940, and all of these report can be so flexible to become a tool to help you to save taxes, right? If you work with 1-800 number, I'm telling you, at the end of the year, you won't get hold of anybody. Nobody can help you to make adjustment, and you're just going to waste all of these good planning ideas that we give to you. So we always tell folks that if you are a very simple payroll and you do planning for us, you make good money, and the place to do your payroll is with the local people you can see, or you work with your tax planner. So we are the one knows exactly what to do for you. So with that said, salary is important. Folks, you want to make sure to know that is one way to spend your profit in the C-Corp. Benefits, so many benefits you can do. You can do qualified and non-qualified. They're all business expenses for C-Corp. So that's why I'm saying that a lot of time is not apple to apple. If you hear me talking long enough, you know how I interpret the C-Corp. The C is what? C-Corp, C represents capitalism, capitalists. So they are the people with money, the holding shares. They're the capitalists. And the C corporation is a corporation that protects the interests of shareholders. That is their goal. Do you know that, if you look at IES, Immigrant Entrepreneur Summit, the goal for IES is to benefit small business owners, providing free platform for them to learn to excel. And we are a nonprofit. We don't do anything but do good for the small businesses. C-Corp, their mission is not the same. C Corporation's mission is to make money for shareholders, period. That's it. And you may say that, oh, you mean they can even be a drug dealer? No, I am saying that as long as you're producing regular business, consumer needed service, you are a C-Corp, your goal is to make money for shareholders. With that said, C-Corp can deduct whatever they want to do for their benefits as long as it's reasonable, right? So I am literally quoting what IRS was saying, as long as it's reasonable. So what is reasonable? You only can discover the unreasonable ones on the tax court data. And the tax court cases are public information. That's why sometimes when you debate with IRS, it's okay, you can debate, but if you don't want to be part of the public domain, you don't want to go into tax court. You want to settle that with your auditors, whoever, before that. So that is one, that's where we look for information. You can find unreasonable compensation over there. And one of the examples I remember is a New York attorney, and he actually would pay for a porno site to look at, naked people. So he classified that as a business expense because without that, he cannot function properly. So that went into tax court case, and it's actually being ruled not reasonable, so he cannot deduct it. But isn't that crazy? I think if he knew that would be a public information, he probably would never go to the tax court. There's no good reason to be there. Okay, examples. On my bullet point, I said the examples including life insurance, certain medical benefit, disability insurance, dependent care, 401k match, more. You can also do non-qualified benefit for your C-Corp as well. In this plan, employee can defer receiving their compensation until future date, but the business can deduct that as expense right away. Okay, most of these benefits are tax deductible at the company level. What does that mean? It just means that their profit can be reduced for the benefit of employee, for the benefit of shareholder. Make sense? All right. So that is the second way. You pay your cash out. You got too much money. You said that you make too much money in C-Corp. I'm just giving you ideas. And the capital repayment and the return paid in capital is not taxable. Okay, so say you started up your business and you put in paid in capital for $500,000, and then now you made all kind of money and you take it back, not taxable, and that is just very clear. And for example, PPP, LDL loan advance, RF, and are treated as paid in capital, ladies and gentlemen. It's not taxable. Okay, all right. Look, you may withdraw cash from corporation tax-free by borrowing money from it. So on your asset side of the balance sheet, on your corporation, there's a loan to shareholder. Your big name gonna be on the chart of account. John Smith took $500,000 from the company as a loan. And to avoid having the loan characterized as John's income, and you want to have a proper document for the loan agreement. So your C corporation is almost behave like a bank. So loaned you money, and that's another way. You make too much money, you have money, so you will loan the money to the shareholder, right? So that can be done. The interest should be at market rate, no lower than applicable federal rate published by IRS. All right. All interest and principal payment should be made when required under the loan terms. Also, consider the effect of corporations' receipts of interest income. Just please don't do 50% loan interest, because you just hate this shareholder so much that you as another shareholder goes, I'm going to charge you 50% of interest. No, because you want to consider the interest income impact on your corporation as well, right? And what about my last one? So we talked about the salary, okay? We talked about the benefit. We talked about the loan, and we talked about another one called property sales. So when you have a closely held C corporation, I'm not talking about Microsoft and Tesla kind of corporation. I'm talking about you. You're the only shareholder, and this is your C corp. And then you can consider property sales. And it's actually, when I wrote this, I was thinking of you want to take money from the corporation. Let's say you have a valuable property that the corporation was using it anyway, but now the business is going so well, you just want that to be a corporation property, so it doesn't tie to you. You just want to sell it to the corporation so you take money back, right? So that is what I mean by property sales. That could be little things like computer and the big things like property. So you can sell any of the property that you have personally to the corporation and ask for a money return. So that way you got your cash, right? And with that you can deal with your profit, because you bought this property, then obviously you have a depreciation, things like that you can deduct. So we are kind of coming through talking about, man, I just got too much money in C corporation, I don't know what to do, and what are the ways I can take it out. So we just talked about that. All right, so to conclude this part of way to get paid under C Corp, of course, dividend is a way, right? I mentioned that in the very beginning. You can always do dividend. And you don't, especially when your cash flow is ample, you just want to do dividend. That's the easiest way, most straightforward way. And your tax preparer can close their eyes to do that for you. But then you also have these other ways I talked about to pay yourself. And there's, of course, taking the dividend income in here. And if you really not sure, you can come to talk to us. We will help you for sure. All right. So this is one of the what if we were talking about. What if I lost a lot of money? I love what if. I remember when my son was younger, my goodness, he just liked this word of what if. So I have to tell him that, can we just not do what if? Or limit your conversation to only one what if. Otherwise, we'll never be able to finish any subject meaningfully. So what if is fun? What if I lose a lot of money? So do you know that in the C corporation, if you lost a lot of money and you know that you can't deduct that, you cannot deduct it like the pass-through to your 1040. You probably figured that out already. If you lost money, you'll be like, can that help me? And the answer is no, because it's a C corporation. Remember, it's separate legal and tax entity. Remember that? The first sentence in the first slide we got today, right? But the loss you have in C corporation is not wasted. It is there. It is there hibernating until you make money, it will offset. So that loss carry forward is for 20 years. Let's hope that by the 20th year, you actually made a lot of money. But let's say you didn't. Then I would have encouraged you to close your C Corp anyway, if that's the case. But do I have a benefit if I just close the C Corp? Absolutely. Absolutely. All right? So let's talk about what if I close the company and never open again? What happened to my losses? So there is an IRC section 1244. Small business investors, people like you and me, we set up a C corporation. We are a small business investors in certain corporations, C Corp. Okay? And the section 1244 allow you to claim an ordinary loss on the sales or exchange of qualifying small business stock, sale, exchange. The loss, we can take that as an ordinary loss. For married file jointly, give you the number. If you lost, say you set up a C corporation for, let's say a restaurant, and you put in $250,000, spend $250,000, and no customer even come in to eat, and you lost it $500,000, and you lost it. You closed it. Now, what happened? Because of certain reasons, you can deduct your first $100,000 in the year you closed. So for married filed jointly, up to $100,000 deduction on 1040. And there, you file that under Schedule D, and you elect that to be Section 1244, and then you put in the money you put in the money you got back, and you have a loss of $500,000. $500,000 would come out $100,000 for you for the first year to reduce that W-2 of $100,000, so that year you don't pay taxes. All the taxes you paid on the W-2 will be a refund back to you. All right, then let's talk about Section 1244 a little bit more. Do I qualify? Section 1244 is applicable when an individual sell and exchange qualifying small business stock at a loss. So to be qualified, there is 4 things we always talked about. The stock qualification, the stock must be issued by domestic small business corporation, which means that it has to be a U.S. company. And if you did that with a foreign entity, that would not work, okay? So it has to be formed here in U.S., and it's a domestic small business corporation. Corporation, did you hear that? That means S-Corp, C-Corp, both are okay. Direct ownership. The individual must have acquired the stock directly from corporation, which means that you did not just because your parents passed away and you inherit the share. No, you have to be the one directly bought from the company. So that is what they call direct ownership. Capitalization limitation. The corporation's total capitalization at the time of stock issuance cannot be over 1 million. So what that means is that if you simply just look at the balance sheet of the corporation, they should not have asset. They should not have the asset over 1 million. And if it is over 1 million, it doesn't qualify the word of small anymore. So like when they issue share to you, they must be a startup and they didn't have a lot of money. So that's kind of the concept for capitalization. Active business requirement means the corporation must have been actively engaged in the qualified business before and after they issue the share to you. So this gives you a sense of Section 1244 normally does not apply to those stocks you bought online with a large corporation. They obviously don't meet the capitalization limit. But what would meet the capitalization limit? Like the restaurant business I was talking about, they put in $250,000, then they lost another $250,000, so they have a $500,000 loss. Their capitalization is for sure under 1 million. Okay, so with that, and because this is direct ownership, the owner actually is the one got the share, and the stock qualification is a company issue, established here in U.S., and its actively qualified business is the restaurant business. So that gives you an idea why Section 1244 would apply, right? If these criteria are met, an individual can use Section 1244 to claim an ordinary loss rather than capital loss. Why it is so important to know, ordinary and capital, what's the difference? If it is ordinary loss, you can offset your W-2, your other income. If it is capital loss, you can only offset capital gain, and you only can take $3,000 of that amount to your regular income. So it's very limited in terms of deduction, and a speedy deduction is not there. All right. So what other things to consider if I want a C-Corp? It is a question I got all the time. Yeah, a lot of things to consider, folks, when you want a C-Corp. So obviously you heard me talking from the very beginning that there is regulatory requirement, right? You want to have annual meetings and all that. And if you are the only shareholder in the C-Corp, you just make sure that you're going to have meeting with yourself, right? And, those are internal documentations. As long as you know to get it done, And in case you get into any litigations or any dispute, maybe the other opposing attorney would ask you for documentation for your C-Corp. You know why they're asking, because it is a required document and you should have. And doesn't mean that you don't have, you're going to go to jail, no. But you may go to jail because the lawsuit is about criminal conduct, right? But normally, if we just talk about non-compliance with the requirement, and that itself doesn't put you in jail, but it is a violation, so you want to be aware of the responsibility having a C-Corp. And when you have a C-Corp, you also want to consider, especially if you set up a brand new one, you want to consider accounting method, because it is easy to do it when you're just starting, rather than started a year, the next year goes, oh wow, I should have selected, mark to market or cash method, and I just didn't do it. So make sure you consciously deciding on that. I use analogy of a C corporation. So it's a person born, and then you want accounting method is almost the language this person gonna speak, because accounting method determines what profit to pay taxes. Very simple, because some accounting method will make you, in your type of business, if you choose a wrong accounting method, you'll pay more taxes every year. But if you choose the correct accounting method, you may save money and save big every year. So accounting method is the language. As a person, if we imagine business like a little baby, then C corporation born, then the language is accounting method. Fiscal year, calendar year, that is their personality. So what do you want your corporation to report income from what month to what month? You want to determine that at that time. And don't wait until you realize, that's just wrong. I want to change my reporting period. Oh yes, there's, it always can be done, but it's just a lot of additional work for your CPA and or even for yourself, right? So we also want to mention to you that when you set up a C corporation, your shareholder can be a person, also can be a corporation, right? So it doesn't, or any other entity like trust. So the shareholder could be another entity. Just want you to remember that. But what about, all of these, okay, that's easy to deal with, and another entity is fine, and as long as I don't pay dividend, and the other entity doesn't matter, right? But what if your other person or your other entity is a foreigner, right? So I want to mention to you that what do you need to do when you have a foreign shareholder in your C-Corp? The requirement is only for the foreign-owned, the foreigners to be a 25% of owning and more owning your entity. So for example, you have this restaurant we talked about. And let's say the shareholder is not just one person, it is actually with another person, and this person never come to US, and he is a foreigner, he lives in Taiwan, let's say. So that person, if the person's share of this corporation is more than 25%, equal or more than 25%, they need to file this form called 5472. Okay, so it is this form called information return of a 25% foreign-owned U.S. corporation or a foreign corporation engaged in U.S. trade or business. Just let's ignore the or, because we're not talking about that. We're just talking about the 25% foreign-owned U.S. corporation. Okay, so I want to lead you to the next page because I want you to see this form, ladies and gentlemen. You want to look at this form. It is very important for you to know. Because if you have the situation, you need to fill up this 5472 annually. Okay, on the top portion is about you, the restaurant. The second portion is about the foreigner. So you want to make sure that you fill this out annually. And also, and coming back to our slide, because C Corporation, because the restaurant, the one we're talking about, profit loss do not flow through to the owner because they are just dealing with inside of C Corp. So the foreign shareholder has no need to file US 1040. Does that make it like lightweight for you? So those business owners, as long as you don't give them 1099 dividend and you don't issue W-2, of course they don't have W-2, they're not even working here, and they don't need to file 1040. But you may say that, oh, Ying, what if I give them the dividend? And if you give them dividend, they are foreigner, it's subject to withholding, and they have to file 1040 NR to get that rectified and refunded. So with that said, you know, as long as you don't touch those shareholders, and they do not need to file 1040. If you don't file this form because you have a foreign owner through your C Corp, you subject to penalty of $25,000. So it is not a small amount. It will bankrupt us if that is the case. You know, of course, there's bigger penalties out there on the internet, and it didn't bankrupt President Trump yet. So, all right, let's say, what if with all of these talk, and you desire to know more? So I want to give you this slide to kind of lead you to know our goal on webinar is not to produce more questions from you, because our agenda is to do it yourself. So we want to tell you what you need to do. Then you're just brilliant. You pick it up and you go, right? But what if you desire to know more? Then you know to search our YouTube channel and learn it from there. Our YouTube channel, you type Community CPA, and it will bring up all of our video. And on the search button, you just type in what you're thinking. Maybe you're thinking corporation. You type corporation. All of the webinars that related to corporation content will come up. I literally have a YouTuber told me that he literally didn't sleep 24 hours because he found our channel, then digged into a whole bunch of things, just listened to it whole day, 24 hours nonstop. And then he come back with questions. Actually, I really appreciate those folks who come to me with literally listed questions. So we knock off the question, clarify their understanding. Is very effective. I like to work that way. And these are the partners, ladies and gentlemen, we have. And I myself, I'm the CEO managing partner. Dr. Hao is a powerful resources for in-depth analysis of our tax laws and the government regulations and the government programs. He just have that ability to read into the massive amount of information, then come up with items of what we need to do. So that would serve you really well if you tap into his talent. And Dan is in charge of our business consultation formation side of things. So if you want to form C Corporation, you come through him. He will tell you what I told you today. And we have a lot of knowledge in our firm, and we can definitely help you. Song, and we put him very special here because he speaks Spanish. Because of he learned Spanish at the office.
you can tell that he doesn't have those special Spanish kind of last name to indicate that. So we have to spell it out. Yes, he speaks Spanish. And he actually knows from business formation to tax filing with his knowledge, and he can answer a lot of questions just in case you're so tired and you don't want to speak English. When I get really tired myself, I actually sometimes come out with Chinese I didn't even realize. And I knew that is when I know I'm tired, because my brain starts to not functioning in full speed, so Chinese will start popping up. Juan, director for accounting, payroll, and the sales tax. And I don't know why it says director. I'll make that change. She's actually a partner. And Derek is also a partner, and he is specialized in IT solutions. So with that, you kind of know our team, and you can engage any one of us on our www.communitycpa.com website. And there is an appointment button. If you go in there, you see us, then you can choose any one of us and get a real answer, get a definite answer that's tailored to your specific needs, right? And the last slide I have for you before I wrap up this afternoon, and is this. Email Catherine at communitycpa.com, and she is the master for knowing what needs to be talked about at what time. And also, we always tell folks that we are a CPA firm. From the day one we started this firm back in 1998, we have always been a 6 days a week CPA firm. So we actually open from Monday to Saturday for our busy entrepreneurs. If you don't have time from Monday to Friday, you have us on Saturday. And we don't just open for tax season. It's just that way. And one tax season, yes, we are busier, but we actually busy whole year, because with tax season, you do the taxes, but then we come into plan taxes before the tax season. So the years just goes from planning to filing, from filing to planning. That's how 12 months goes for us. Of course, we also provide other services as well. We do accounting, and we do formation, advisory service. We have CFO package for people to hire as their CFO. And we also have payroll service. That's what Kwon is specialized. So I'll talk to all of you again, and I hope you enjoyed this webinar, and see you again. Bye-bye.